folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. A little bit of a return of Mr. Toad's wild ride to the marketplace. For those of you who are checking the markets on a daily basis, the first message is obviously stop doing that. But the second message is, on Friday of last week, we were down about 2.7% on the S&P 500. We rallied back on Monday, got about a 1.6% gain. And as I sit here today, we're at about 65.73, down about 1.3%, on Tuesday. Still up about 12% for the year, but the market, after a little bit of a rally on Monday, giving it back again here, basically back down to the low that we set on Friday at the close. So let's dig into a little bit why. This is all about ostensibly China trade, although we're going to talk a little bit about sometimes, the catalyst then gives, voice to some other concerns. Started on Friday. Let me set the backdrop a little bit better. Previously, people viewed that there might be a warming in trade relations between China and the United States. There was certainly an economic summit sort of negotiation set up here pretty quickly. Leaders were supposed to meet and potentially hash out a deal, et cetera. And then on Friday, China basically came along and said, hey, we're gonna throw a little bit of a monkey wrench into those plans. We are going to basically put restrictions on rare earth exports. I'm not going to get into all the details of why that's a problem, but China does have effectively somewhat of a monopoly on rare earth mineral supplies. And we need those for electronics, for defense, et cetera. So it's a very sensitive trade issue between the two countries. China basically came out and said, hey, you know what? We're going to put some export controls, et cetera. We're going to restrict access to these minerals. U.S. basically coming back on Monday and saying, hey, we're going to slap a giant tariff on additional tariff on Chinese goods in retaliation. And oh, by the way, doesn't make a whole lot of sense for us to meet if this is going to be your trade posture. And the market, I guess, kind of rallied a little bit on the back of that maybe it wasn't going to be so bad that the two sides would negotiate with one another. And then today, we see China coming back and sort of doubling down. And interestingly enough, slapping some some sanctions on some South Korean firms that actually have favorable trade status with the United States. So China actually going a step further and saying, hey, this isn't just about trade with the United States. Now we're going to start to go after some partners of the United States in terms of their trade, obviously is not being received well by the marketplace. You can look at this a couple different ways. On the bull case side, you can kind of, I hate to use the phrase taco, but on the bull case side, you can say, hey, these types of spats seem to have happened frequently, and we always sort of negotiate our way through them. This will get resolved quickly, and away we go, so nothing to be too terribly concerned about. The bear case of this would be, hey, no, the administration's not going to cave this particular time, and this is going to be a big deal and might spill over into more of what I'll call a global camp of trade, right? You're either on the U.S.'s side or you're on the Chinese side. Certainly starting to see, that move by the Chinese is very interesting because it is targeting, trading partners of the United States, which is not something that we necessarily seen at least that explicitly before. And then the bear case is, hey, it actually takes a pretty significant market correction before the administration sort of, wisens up, or before the administration sort of feels the need to come to the table and start to negotiate. So we will see how all of that plays out. Meanwhile, sometimes these catalysts on trade actually give the market a reason to think about, how everything else might be kind of bad around the neighborhood. I liken this a little bit to, when something goes wrong in one area of your life, you are tempted frequently to look at all the areas of your life and say, oh my gosh, it's bad here. It's also bad everywhere else. Market sentiment can be the same way. The shutdown drags on. We're coming up on a time period where people are going to start to miss paychecks. Eventually, that will start to continue to flow through into consumer sentiment and into consumer spending. Markets, as we've talked about before, are generally willing to look past what they view as sort of a short-time incident. But, to the extent that this weighs on consumer confidence, to the extent that this weighs on consumer spending, to the extent that that then flows into what was really kind of a blah unemployment situation to begin with, that may create some concerns that, hey, maybe this government shutdown thing is a little bit more of a tipping point. Maybe we should be a little bit more concerned on the other side of it. And I would just say that hopes for a quick resolution here seem unlikely. It is interesting that the polling data pretty clearly indicates that on average, voters are believing that this is the Republicans' issue to resolve, not the Democrats, which kind of emboldens the Democrats to continue to stand up and puts the Republicans in sort of an awkward place of, okay, well, do we want to see this through or do we not? And so we'll have to see. Obviously, a game of brinksmanship going on there. Until we get that resolved, we won't get any sort of macroeconomic data to sort of let us know, what's happening out there, other than consumer confidence data, which will continue to be published, which candidly hasn't looked all that great. And that's one of the reasons why we've seen bond yields come in about 10 basis points or 0.1%, all the way down to about 4.04%. The market now fully pricing in effectively 2 more cuts out of the Fed between now and the end of the year, which I will say is a pretty aggressive rate cutting cycle. If you think about the fact that we're sitting here in mid-October, 2 more cuts by the end of the year, basically, is pretty much, it's a pretty aggressive pace of rate easing. So the market clearly, at least the bond market, telling you that, we need to get out of restrictive territory, or at least saying that they believe that the Fed will believe we need to move us out of restrictive territory. Anyway, it's not a very bullish sign of the health of the overall economy. And by the way, this type of volatility, I will just remind you, is why we diversify. It is why typically you hold a diversified portfolio. I will just note, if you look at international stocks, they are outperforming over the last 3 days by almost 100 basis points or 1% versus domestic stocks. That's expected. What's largely going on here is a trade rift between the United States and China. And China actually makes up a very, very small portion of international stocks because most of their companies are held domestically. And so you're seeing the rest of the world actually do better comparatively than those two countries. That's why you include international in your portfolio. And oh, by the way, it's also why you include bonds in your portfolio, because as we mentioned before, bonds coming down a little bit in terms of overall yield. As yields move down, that means prices move up. And so bonds actually in positive territory over the past 3 days, which you kind of expect to see that inverse correlation. That's why you own bonds. That's why you own international. That's why you own a diversified portfolio. And that's why, once again, we don't really try and market time this because we try and go into it with a diversified portfolio to start with. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.